Welcome all. What is happening out here? You see a picture? There is something going on, right?
So most of them are sneezing.
They are sneezing. Are you sure?
They are crying.
They are crying. Okay. Why they are crying? So there must be something else. Some are wearing gloves also. So is anything wrong here?
They may be afraid for corona and they may be wearing gloves, mask.
They are wearing mask, right?
Yes, sir.
And they are crying also.
Yes, sir.
Okay. Maybe their relative or friend or maybe somebody, their own people died. It's very natural because man is mortal. Human is mortal. So this is inevitable. Somebody died due to some reason. We don't know. But they are crying. They are crying means something went wrong.
Yes, sir.
So can anyone correct it so that they can smile once again?
Bring that person back.
Impossible. Yeah, there is a saying, you have your aim, ambitions, everything, but that should be within a limit. If you say I have to jump and I have to touch the sky, it's not possible. But I can try jumping to something where I can, like at least my roof here. They will try their best so that these people, they will smile once again. That's not possible. Why they are crying? Suppose somebody died, then why they are crying?
So due to some loss.
Due to some loss, but something must be there hidden.
So they miss the person in their life.
Yeah, obviously that is one of the main reason I'm saying. Okay, but there must be another reason. Most of the time, there is a concept of dependence. Suppose these people helping the other persons, they go to the offices, they work, they earn 1 lakh a month. Okay, now the 1 lakh will not come to them. So how they will survive? Suppose these are the people, they never worked in any company or in government offices, and for the first time they will start working at 35, 30, whatever. So be ready to work because survival of the fittest is something we need to believe. They would like to work, but jobs are not plentifully available. They might not get jobs. They're crying obviously now at this time because they lost their close ones, but it might linger for a longer time. Today they are crying because they lost the person. Tomorrow they might cry because they have nothing to eat. This is a disaster. They lost their close ones, but they are no more here. So they are crying for the first day. Obviously they're crying now. Next day also they might cry. After 1 month also they might cry. But after a year or two, they will not cry. Why they will not cry? There are two reasons. Either they will not get anything, any job or something like that, so that they can live their lives. They will also die. They will not be able to cry. Or they will get a good job somewhere and they can earn their livelihoods. They will not cry. These are the two reasons. So let's recognize the problem. Insurance company says, never mind, we are there. We are there with you. You continue working. Suppose you die tomorrow, we can bring you back. And what will happen? Those who are dependent on you. So take a policy. Take a policy that is called life insurance policy. Whenever you will die, we'll give some amount to them. What amount you want? Suppose you think lakhs, 20 lakhs, 50 lakhs, 1 crore, 10 crores, whatever amount you think that they will be needing immediately for their survival. If you say that amount, then we'll give you policy. See the people. Now they lined up. Anyone? The first one. Let's start from the women.
40s.
40. She's looking like 40.
So 25 to 30.
Yeah. Okay. 25. Because why I'm writing age? It will depend. If age is 35 or 40, they might charge more. Because insurance company, the people here, they are not sitting here to give you money. I mean, your dependent, suppose this woman is working, and when this woman is not there, okay, so whoever is supporting, called nominee, company wants to give money. So they are not, it's not a charitable trust or government that they will give money. The money, the bank will, I mean, the insurance company will take from each one will be different from person to person. It depends on age. So how much money the insurance company will take from each one? How it will be decided? Who will decide how much to take? The final authority or
The
who?
company,
Company will decide. How they decide?
based on the premium amount, they will divide with each other.
No, they will divide, that's fine, based on the premium. I'm asking that premium amount. Suppose it's one time only. Whoever is sitting here, okay, they must have policies, everything is written, because this guy is not doing everything. So in the back office, it will be done, okay? The pricing is done here in the back office. So all people are working here. These are salesperson, they will sell only. Everything is written. According to age, it will be done, because more the age, more the death probability. Here, though, there is not a lot of difference, but come to this. Can you tell me the age here, this guy? 65? And this women?
40.
This women?
40.
40, maybe, yeah, 40 years. How about this?
So 35.
35, yeah. Okay, and this women?
60.
60 you said, okay.
50.
All right, and this retired or not? Yeah, retired for sure. He's not standing proper. I mean, rest. She looks young, but maybe 35. 62, no, 69. This guy looks quite active. 69, suppose. Don't like people who are more than 55 or 60. You
No,
said
sir. No, sir. Not like
okay. You tell me any. This guy will be more than 60. I mean, I think 50,
65.
65 only. Okay. And this women also
60.
maybe 60. Okay. And this guy
55.
55.
Sir, he's standing straight.
No. Maybe 48.
Okay.
You thought I will write more. Yeah, not more than 48. 25. Suppose it's 1. Okay. Because if you change the sum assured, suppose today you say 1 crore, tomorrow you say, no, I want 2 crores. My dependent should get 2 crores when I die. Then what will happen? Insurance company will increase. So it will depend on the sum assured. Age. These are the two important things. I'm talking about one-time premium. That will also come later. Suppose he is 25 now and she will die between 55 to 56. So 30 years. 30 years means monthly. 12 into 30 premiums she will pay. We'll go to that later. Immediately I'm saying only one time. One time pay, one time receive. One time give, one time receive. If that happens, and the sum assured is one unit of money, then how much the company will charge, or what will be the policy value or cost, whatever you say. We'll do mathematically, but remember, it's A25. A25. We'll go to what is A25. So she has to pay A25 to the insurance company. This girl will pay A20. Okay. Then this guy will pay A30. How much this girl will pay? Wrong. Who
So
can?
she's not eligible for the policy.
Yeah, not eligible. So minimum 18 years of age. Company will charge A28. Okay. And this anyway not eligible. So these are the premiums, you can say. They have to pay to the company. Okay. If you want to know what are these values, you have to go to actuarial table. In actuarial table, everything is estimated before. How it's estimated, that's a part of CS2 course. Will not worry about that. And don't see here and there everywhere. Okay. Then there will be problem. You see only what I say, one column. Okay. Suppose we want X. See the first one, second one, third one, fourth one, fifth one, sixth one. You see only sixth column. We'll start with sixth column, and in course of time, we'll go here and here, left, right, everywhere, wherever possible. But now you only target to this column, sixth column. Okay. And here AXs are given and the ages are given. It starts from 17 here. So yeah, we can make it little bit, because it depends, that is UK. Make it 16. So suppose someone is 30 here. You just see this here. This is 0.073. AX value is, remember 6%, there also will go. AX value is 0.073. Okay, at age 30, AX value is 0.073. That means to get one, you have to pay this. Okay, if you want to get suppose 100, you have to give 7.3 paisa. You see, you bring this decimal here. This is 0.073, 0.07328. So it will be 7.3. So 7.3 paisa you have to give. Suppose you are 40, you see it will be more. Suppose the guy is 60, up to 65 it's valid. Because minimum 10-year insurance you have to take. So if you come to 40 here, okay. Yeah, if you come to 40 here, we have annuities also. That's why this is given up to 110 age. Okay, this is mortality. They've given everything in one place. That's why this depends on mortality. So 40 here, 0.23. That means you have to pay 0.223 to get one. Okay, I'm writing this. A40 is 0.23. Is 0.23. That means insurance company says if you want your dependent or nominee to get 1 rupee, you have to pay 23 paisa. So pay 23,000. You take 1 lakh. Okay, that way. 1 lakh. So to get 1 lakh, you have to pay 23,000. If you think no, premiums are very less, this is one time premium. A40 is the full amount. For sum assured 1, it's 0.23. For sum assured 1 lakh, it's 23,000. Okay. So 23,000 if you pay, then when you die, your dependent will get 1 lakh that way. So this A40 is to get 1. A40, now you need to pay to get 1 in future. Whenever this guy dies, whenever this woman dies, here insurance company will pay 1. Now A40 value we found 0.23. So pay 0.23, take 1 that way. We'll go to the mathematics later. And that too, this is company, insurance company, life insurance company. We are interested in life insurance company now, not general insurance, motor car insurance. The mathematics of life insurance is totally different from the mathematics of general insurance. So this company will also check the interest rate in the market. If the interest rate is 6%, suppose this is bank market interest rate is 6%, okay. Then because there is a mathematical formula, I'll go to that. Then it will be 23 to 1 that way. You remember 23 to 1, A40 to 1. A40, you can see the table. Even after a few classes, you will be able to find the value of A40 with a lot of efforts though. So this guy is not eligible, unfortunately. And C is eligible. This guy is not eligible. Okay. So A35, this guy is to pay to get 1. A40 we have written. A55, this woman has to pay to get 1. Now they will pay these amount. These are called premium, one-time premium. They are not eligible, unfortunately. Active, we say they're not active anymore. See, the insurance company is this actually. Okay. Most of the insurance companies are like this. Now, next comes this one, premium calculation. Okay. That will depend. It's not fixed. It will depend on the amount. What amount you want. It will depend on that. So if you want one amount, they will charge AX from you, where X is the age. It will depend on the age. Now the bank's interest rate, like we have taken 6%. And fortunately for you, they've given values only at 4% and 6%. Fit and fine, alive. The time starts now. Somewhere this guy will die. Okay. Obviously, we'll make it black. This guy will die somewhere. Now working, fit and fine, everything. When this guy will die, then what will happen? Company has to pay money. Okay. So company will pay some amount here. If this amount is 1, how much you need to pay to the company? That you need to decide. You see the present value of this here. In CT1 we find present value. Here we say expected present value. Suppose this guy is 40, age 40. So A40 is the expected present value. So we can write A40 or AX. AX is expected present value. 40 age now. So unlike CT1, we have to write 2 lines here, 44 that way. So this is 1 year, this is 1 year, this is 1 year that way. Suppose due to some reason we know that this guy dies here, then we can find the exact value, but we are not sure. That's why the problem is. The problem is we are not sure that he will die between 4 to 5. I have written here in the diagram, that's separate thing, but company has no idea when this guy will die. So this is average. On an average basis, they calculate. You will be able to know how we calculate, how to find this average. That's why we write average present value, expected present value. So I'll write this way. We'll go to the derivation later. Expected present value of 1 unit of money now. Okay. Where the sum assured is 1. That's all. This much you write. Present age also you have to write. Present age is 40. Expected present value, or you can say premium, is A40 to get 1 in the future. We'll go to the derivation later. I'm not going through that. So suppose you have a problem when sum assured will be given. Suppose it's 50,000 and age is given. It's 30 or 40 here. Suppose this guy, and whole life policy. This is the type. And the benefit, where you need to take the benefit, immediately here or at the end of year of death, it will depend. We'll start with this one, end of year of death, this one. So if the person dies here, the payment will be at the end of year of death here, not here immediately. So there are 2 cases. We will start with the first case, end of year of death only. So we'll write here whole life, and money is payable at the end of year of death. Then how can you solve this kind of a problem? You write EPB of outgo. Outgo means for the company. Is EPB of income. Income for the company is called premium. One-time premium now. That is what company will charge. What is EPB of outgo? Outgo is this one. When the person will die, whatever they will pay, that is the outgo. But present value of outgo is A40. So this is the premium amount. You have to start writing this. So this is a small problem. Company wants to take some money. So how much company will charge? Suppose this woman is 25. A25. If you want to know A25, you have to see, we have considered that the market interest rate is 4%. Okay. So this way it's calculated actually, practically. You see 25 it's written 0.133. Okay. So I know that 0.133 at 4%. Market interest rate is 4%, then only. If 5%, then because you are studying 2% given here, 4 and 6, for every percentage you will be able to find in the company. So 5, 6, 7, 7.5, whatever is there. Okay. Suppose at 4% is 25, it's given 0.13386. Let me write here 0.13386 for sum assured 1. So they will ask this woman, okay, what is the sum assured you want to take? If he says I want 5 lakhs, okay, so you have to multiply. If sum assured is not 1, it's 5 lakhs sum assured, then what will happen? This amount for sum assured 1, but for this sum assured, this 5 lakhs, you have to multiply this with 5 lakhs, okay, or you make it 1 lakh, multiply here, easily you will be able to get 13,386. This is the total amount. Now if she says no, I'll not be able to pay 13,386, it's a very high amount, they will say okay, one time if you can't pay, you will divide this into an annuity and you can pay monthly, quarterly, yearly, whatever way possible, and we'll go to that. That will come after some classes, 3-4 classes. And so it will depend on the sum assured. So these are fixed. The next thing you need to multiply is sum assured. Okay. Suppose sum assured is S1 here, S2 here, S3 here, you have to multiply. So the first equation of value, remember this way, this is called equation of value. This is the equation of value, okay? Because sum assured, okay, sum assured I wrote 50,000, I forgot to write. For one, sorry, this side I have to write. This is the formula you need to remember. Sum assured into AX. So you have to know what we have written. This is income for the company. That is outgo for the person, okay, for the people, outgo. But subject is company. So we say always income, okay. Expected present value of income. Company will charge this amount. So whoever is giving policy, you have to pay this way, P to the company, okay. It will go to the company. And company will not pay anything now. Company will pay S amount. X is for one amount, SX for S amount, okay. Company will, now we have to pay one, sorry, P premium, and company will pay whenever the person dies, company will pay here S instead of 1. So that S you need to multiply. That's all.